You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well on this Wednesday. Today I'm looking at a small position in my portfolio, but a company that I love, and damn, it has not reported good returns over the past few years. So we are going to do a deep dive into Canadian National Railway, ticker CNR.TO or CNI if you buy it on the US side. So over time, my portfolio grew, but Canadian National Railway, not so much in the past 5 years. And for that reason, it became a smaller position. So it used to be a great one. Now it's like just below my target position of like 3%-ish of what I want in my for a new position, for example. So when we look at the past 12 months, the total return is about minus 10% versus 22%. Like up 22 for the TSX. For the past 3 years, CNR is up 6% total return versus 56 for the Canadian market. So again, not doing that well. And over the past 5 years, the TSX like doubled in value. So 99% return versus 30% for CNR. If you look at the past 10 years, well, then it's a little bit better. So 10 years is 137 versus 161. So that could do it. But over the past 5 years, oh my God, that was not a good performance. So let's take a look at my investment thesis, and then we'll look into the numbers to see what is going wrong. So of course, Canadian National Railway, amazing business, railroads, connecting Canada with the US, with the Gulf of Mexico. They have like plenty of different segment for transportation. So you have like intermodal containers, grain, fertilizer, petroleum and chemical products, forest products, metals, automotive, coal. You have like agriculture stuff, like everything is there. And I love the fact that they're well diversified like this, because then they can when automotive is doing great, well, it can compensate for another one and vice versa. So they are in a very good place there. The growth is, of course, getting new customers to use the railroad network. You have like international intermodal expansion that is there. You have like good pricing power because there are not that many competitors out there. So those are the things that are relatively interesting, and the company is, of course, generating tons of cash flow from the transportation of goods year over year. The economic moat here is quite obvious. I mean, they have an asset that is almost irreplaceable and cannot really copy. So the infrastructure of the railroads, almost impossible to compete with, and because they are coast to coast across Canada, they can deliver pretty much everything everywhere. So those are like the big economic modes. So long story short, the investment thesis pretty strong, but the numbers now not that great. So keep in mind the revenue. When you look at the revenue over the dividend triangle, at Dividend Stocks Rock, I can see like 10 years, and I see that there are times where you have slumps, right? So 2016, 2017 was not that great. And then 2018 increased a little bit. Now we had COVID. So between 2020 and 2022, not much growth. Then big growth to 23. And now from 23 to 25, struggling revenue once again. So long story short, the past 5 years, revenue growth rate is slightly below 3% in annualized growth rate. Not really sexy, right? If you look at the earnings per share, we're slightly below 4%. So again, it's better in revenue, which is good, but not impressed. And the dividend is actually quite high at 9.45, but that is going to stop at one point. So if revenue and earnings are growing low single digit, well, the dividend will also have to follow. So that's not a good thing right now. So of course, it's cyclical. Like a part of it can be explained with the tariffs and stuff, but still not that great. Interestingly enough, when I compare with CP, Canadian Pacific, I see that they're actually doing good. So in terms of revenue, of course, you have like the 3% for the revenue growth rate at CP, Canadian Pacific. Well, I should be saying like Canadian Pacific, Kansas City. The Because of the merger, the revenue growth is at 13%, but the EPS at 2.6. So 375 on one side, 2.6 on the other, and they just increased their dividend, but they did not over the past 5 years. So of course, dividend growth rate. Then again, CNR is winning this one. So in terms of numbers, they're not impressive, but when I compare it to CP, I'm like, all right, so it's not the end of the world, right? They're actually not doing that bad. The other super important metric to look at is the operating ratio. That is like one that is super important. One reason why is because the operating ratio calculates how much the company spend in maintenance for the railroad, and then it's kind of like a good indicator of like how the margin will look like. So best in class, you should be below 60%. And there's kind of like a thin line, because if you don't spend nothing, let's say that you have like an operating ratio of like 40%, you look like a genius. But that probably means that eventually your network is going to fail because you don't put enough money on it to have a good maintenance. So best of class most of the time, usually slightly below 60%. That is like the key target, which has not been achieved over the past few years. So in 22, we have an operating ratio of 60. Canadian Pacific was at 62.2, so actually better at CNR. In 23, 60.8 versus 65 at CP. So again, CNR is better. In 24, 63.4. So you see that we are on an increasing trend here from 60 to 6.8, so almost 61, and then 63. If you look at CP, they are at 64.4, so it's better than 23, but still lagging behind CNR. And then Q1 of 2025, we were still at 63.4 for CNR and 65 at CP. So once again, CNR's metric look better, not incredible though, and that probably explain why people are not super excited to invest in CNR. So the dividend triangle is not that great. The operating ratio is increasing, so nothing to really help. One other thing that I did though is I've looked into the valuation. So I've looked into the P/E ratio for both, for CNR and CP. And at CNR, the forward P ratio is at 17.5 versus CP at 21.8. So kind of crazy, big difference here. And the average over the past 5 years was like 22 for CNR, 26 for CP. So while 22.6, so almost 23 for CNR. But still, the on one side, it seems that you have a value play with CNR, while CP is more a bet on future synergy that will be created with the merger of Kansas City, which totally makes sense. It makes sense that you're paying a premium right now for CP because, yes, it was a big chunk to swallow, but down the road, it should be profitable. So I would say the thesis for CP is stronger, but the numbers right now are slightly better for CNR. And the reason why it's not performing up to the TSX at this point is definitely the numbers that are not impressive. So it doesn't generate any hype, any good trend. So in conclusion, I would say my investment thesis is still valid. This is a kind of like more like a bond proxy than anything else in my portfolio at this point, I have to admit, because over the past few years, like the performance has not been great, but the dividend keeps on increasing. The company will be there forever, but the numbers are not that great, which explains why there's absolutely no momentum around the stock, which is too bad, but that's also the point of having a diversified portfolio, right? So while I'm looking at this one and I'm not super happy about it, well, I can look at other holdings in my portfolio and say, hey, those are great and they're generating great returns. And at one point or another, when the economy is like a little bit more stable and the outlook will look better, I'm sure that transportation is going to pick up, and then CNR is going to make more money, and of course, it's going to drive the stock price higher up. So at this stage, not disappointed. I mean, I'm disappointed by the performance, but I'm happy having it in my portfolio. It's too bad it became a small position. I might eventually consider adding a little bit more capital to this one. Actually, it's probably a good timing to do that, but we'll have to be patient, right? So, all right, Moose, I hope that you have enjoyed this one. Do not forget to subscribe to my free dividend growth newsletter at moosemarkets.com. So, moosemarkets.com, just follow the link and then subscribe to the free newsletter to get more stuff like this one. All right, so on Friday, we are going to talk about how can you protect your portfolio at retirement for a potential crash, because maybe that's going to happen this fall. So we're going to take a look at how you can protect your retirement portfolio. All right, until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.